Money used to move at human speed. A deal took hours, a decision took days, and power looked slow because the system was slow. But that world is gone. Now money moves at machine speed. Markets react before humans notice the signal. Credit decisions happen while you're still typing your name. And here's the shift most people miss. Finance didn't just get faster, it got automatic. For decades, computers helped humans analyze better charts and better models, better forecasts, but a human still pulled the trigger. Today, that trigger is moving from human hands to machine loops. A modern financial system is a loop. Sense, decide, act, learn. When the loop is slow, the world has time to breathe. When the loop is fast, the world has time to react. But when the loop is automated, the world has no time at all. That's why AI doesn't just predict. It selects actions, and when actions are selected automatically, execution becomes the product. Execution decides pricing. Execution decides approvals. Execution decides who gets friction and who gets flow. This is where power changes shape. Because power in finance is not a title. It's not a building. It's not even money. Power is the ability to move first and make everyone else move second. In markets, milliseconds are not time. They're territory. If you can see a signal before others, you can position before others. If you can execute before others, you can profit before others. And if you can learn before others, you can widen the gap permanently. That gap has a name. It's called a moat. And AI builds moats quietly. Not with speeches, with infrastructure, data centers, fiber lines, models, pipelines, access. These don't look like weapons. They look like efficiency. But efficiency at scale is control. And control is what this is really about. Because once execution becomes automated, whoever controls the machines controls the order. Now, if that sounds abstract, make it personal. Think about a credit decision. 10 years ago, you filled out a form. Someone reviewed a score. Maybe a person made a judgment call. Today, the decision can happen in seconds, sometimes in the background, while you're still typing your name. And you don't just get approved or declined, you get routed. More steps, fewer steps. More verification, less verification. Higher rate, lower rate. More suspicion, more trust. Not because a human dislikes you, because a system optimized the rule, and that's the point. When the system is optimized for speed, it's also optimized for scale. And when it's optimized for scale, it becomes difficult to challenge. You can argue with a person. You can't argue with a pipeline. So the question isn't whether AI will change finance. It already has. The real question is who benefits first and who pays without noticing. Because the new financial order won't arrive with the headline. If part 1 was the hook, part 2 is the mechanism. Because the new financial order isn't built on money. It's built on loops. Every modern financial institution runs the same cycle. sense, decide, act, learn. The only question is, who runs the loop faster and who gets trapped inside it? Start with sensing. The old world sensed reality through reports, quarterly statements, delayed indicators, human analysts reading yesterday's signals. The new world senses reality in real time. Transactions, clicks, location patterns, device signals, market micro-movements, and millions of behavioral traces that never existed before. AI doesn't just see more. It sees differently. It spots the invisible patterns, the subtle correlations, the ghost in the machine that tells you what's about to happen, not just what already did. This isn't about hindsight anymore. It's about foresight, generated by algorithms processing a constant stream of information. Then comes decision. In the old world, decisions were meetings, committees, risk councils, slow human debate, filled with biases and groupthink. In the new world, decisions are scores, probabilities, triggers. They are automated models that calculate risk, predict behavior, and determine outcomes in milliseconds. Rules that run without anyone in the room. A decision isn't a long discussion. It's an instantaneous calculation based on all the data the system has sensed. It's cold, efficient, and relentless. This is where the machine takes the wheel, turning complex data into a simple, actionable choice. Yes or no, buy or sell, approve or deny. Then comes action. Action is where finance becomes power. It's not just a theoretical model, it's a real-world consequence. Action is the order routing that finds the best price before anyone else, the credit limit that gets approved instantly, the interest rate that changes dynamically, the fraud flag that freezes an account. It's the extra verification that adds friction to one person's transaction and removes friction for another. And those micro actions stack into macro outcomes. In an automated system, friction is not random. Friction is a tool. It's a precisely engineered force to guide behavior, manage risk, and ultimately to shape the market itself. Now the final piece of the loop. Learning. A fast system doesn't just act. It learns from its actions immediately. Every transaction, every outcome, every piece of feedback feeds right back into the model. More data creates better decisions. Better decisions create better outcomes. Better outcomes create more adoption. More adoption creates more data. That's the flywheel. And flywheels create concentration. The systems that learn fastest grow fastest. They accumulate data, talent, and capital, creating a gravitational pull that is almost impossible to escape. The rich get richer, and the smart get smarter at an exponential rate. So the question isn't, is this fair? It's, where is the control point? Who sets the rules for the loop? Who designs the algorithm? Because wherever the control point sits, power will follow. The new titans of finance aren't just the ones with the most capital. They are the ones who control the loops that deploy it. And in part 3, we'll zoom into the most brutal control point of all: speed. Because in modern markets, speed isn't just a convenience. Speed is leverage. Ever wonder what really gives traders an edge in financial markets? Is it a crystal ball? Insider info? Or just being a genius? The real answer is a lot simpler and a lot faster. It's all about speed. Not just the speed of your internet connection, but the speed of your entire decision-making loop. Think about it. The financial market isn't a level playing field where everyone calmly submits their best ideas. It's more like a high-speed race where the quickest participants don't just win. They actually shape the racetrack itself. Imagine you and I both have the exact same brilliant trading idea at the same time. If my system can execute that idea a millisecond faster than yours, I don't just get the trade first, I get it at a better price. My action changes the market price, so by the time your order arrives, the opportunity has already shifted, or worse, it's gone. My speed created leverage. I used a tiny time advantage to amplify my gains, and it came directly at your expense. This isn't just about one trade. When this happens millions of times a day, the fastest players are effectively setting the price for everyone else. They're not just participating in the market, they are the market. This creates a kind of territory. The fastest firms carve out a space where only they can operate profitably. If you're not in that super fast lane, you can't even compete. It's like trying to race a Formula One car with a bicycle. You're just not in the same game. And this speed isn't just about a faster computer. It's a whole ecosystem. Faster data feeds, faster algorithms to process that data, and faster hardware to execute the trades. This entire stack is built for one purpose: to shrink the OODA loop area. Decide, act. The faster you can cycle through that, the more you control the game. So, how does this speed create an exclusionary moat? It's because the process becomes opaque. When trades happen at the speed of light, it is nearly impossible for a regular human or a slower system to understand what is truly going on. The market's source code is being written and rewritten in microseconds. This opacity benefits the fastest players. They understand the intricate dance of orders and cancellations because they are the choreographers. For everyone else, it just looks like noise. This information asymmetry is the ultimate barrier to entry. You can't beat a game when you can't even see how it's being played. This speed advantage isn't a secret trick. It's a fundamental feature of modern markets. The edge doesn't come from having a better opinion on whether a stock will go up or down in the long run. The edge comes from executing your intentions faster than anyone else. It transforms a market of opinions into a market of reflexes. And in this world, the fastest reflex always wins. It's a system where being first isn't just an advantage, it's everything. It's the leverage that moves billions, the territory that defines profit, and the moat that keeps outsiders at bay. The key takeaway is that, in finance, speed is power. It is the mechanism that allows a small group of participants to exert a massive influence over the entire system. They don't just predict the future, they create it 1 microsecond at a time. It's a fascinating and slightly terrifying reality of the world's financial plumbing. In the heart of our global economy, a silent revolution is underway. It's a world built on algorithms, high-frequency trading, and artificial intelligence. Every day, trillions of dollars are moved, invested, and managed not by human hands, but by complex automated systems. We've entrusted our financial future to code, believing in its efficiency, its speed, and its impartiality. But this raises a critical question. In this new digital frontier, who is actually in control? Let's travel back to May 6, 2010. In a matter of minutes, the Dow Jones Industrial Average plunged nearly 1,000 points, wiping out almost $1 trillion in market value, only to mysteriously recover just as quickly. This event, known as the flash crash, wasn't caused by a major geopolitical crisis or a massive corporate failure. It was triggered by a single, large automated sell order that set off a chain reaction among thousands of other trading algorithms in a market dominated by machines programmed to react faster than any human possibly could. A feedback loop of selling spiraled out of control. It was a stark wake-up call, revealing the fragility hidden beneath the surface of our automated financial infrastructure. The very systems designed for stability had in an instant become agents of chaos. So, how do these systems work? At its core, automated trading uses computer programs to execute buy and sell orders based on predefined rules. These rules can be simple, like selling a stock if it drops by 5%, or incredibly complex, involving machine learning models that analyze news sentiment, market trends, and economic data in real time. High-frequency trading, or HFT, takes this a step further, using powerful computers to execute millions of orders in fractions of a second, capitalizing on tiny price discrepancies. The speed is mind-boggling. These firms measure time in microseconds, millionths of a second. They even co-locate their servers right next to the stock exchange's data centers to shave off a few extra nanoseconds in communication time. In this world, speed isn't just an advantage. It's everything. The promise of this technology is undeniable. Automation can increase market liquidity, reduce transaction costs, and eliminate the emotional biases that often lead human traders to make poor decisions. An algorithm doesn't have bad days. It doesn't get greedy or fearful. It simply executes its programming with cold, hard logic. This efficiency can, in theory, create a more stable and predictable market for everyone. But, as we saw with the flash crash, theory and reality can be worlds apart. When thousands of independent, lightning-fast algorithms interact, their collective behavior can become unpredictable. Each system might be following its own logical rules, but together, they can create emergent patterns that no single programmer ever intended or could have foreseen. This is the central paradox. We build these systems to impose order and control on the inherent randomness of the market. Yet, their complexity and interconnectedness create new, unforeseen risks. A small software bug, a misinterpretation of a news headline, or a sudden, unexpected market event can trigger a cascade of automated reactions, leading to system-wide instability. Regulators are in a constant race to keep up, developing circuit breakers and new rules to prevent another flash crash. But they are often one step behind the technology. How do you regulate something that operates at the speed of light and evolves faster than laws can be written? The rise of AI in finance adds another layer of complexity. We're now moving beyond simple rule-based algorithms to self-learning systems. These AI models aren't just following instructions. They're learning, adapting, and developing their own trading strategies. They can analyze vast data sets and find patterns that are completely invisible to the human eye. This is an incredible leap forward in capability. But it also means we are ceding even more control. When a self-learning AI makes a decision, we don't always know why. Its reasoning might be buried in a black box, a web of neural networks so complex that even its creators can't fully decipher its logic. What happens if one of these black boxers learns the wrong lesson? What if its strategy, while profitable in the short term, introduces a massive systemic risk that no one sees coming until it's too late? We stand at a crossroads. The automation of finance is not something we can reverse. The efficiency and power it offers are too great to ignore. The real challenge is not to stop this evolution, but to guide it. It requires a new kind of oversight, one that is as dynamic and adaptable as the systems it seeks to manage. It demands greater transparency from financial firms, robust testing protocols for new algorithms, and perhaps even AI ethicists who can help ensure these systems are aligned with our long-term goals of a stable and fair economy. The question is no longer just about who controls the money, but who controls the code that controls the money. As we continue to build this automated future, ensuring that human values and human oversight remain at the heart of the system is the most critical investment we can ever make. Thanks for watching. If you found this exploration of our financial future interesting, make sure to like, subscribe, and hit that notification bell for more deep dives into the technologies shaping our world. See you in the next one.